All right, let's talk taxes. Every single year, you've got this one big decision to make. And it's a huge deal because it literally determines how much of your hard-earned money is actually taxable. In this explainer, we're going to break it all down so you can make the right call.
So here's the big question. Are you taking the standard deduction or are you itemizing? You know, getting this right could save you thousands of dollars. Seriously. But if you get it wrong, well, you might just be leaving a big tip for the government. So let's figure this out.
The best way to think about it is like you're standing at a fork in the road. One path is super simple, just straight ahead. The other one's a little more winding, requires a bit more effort, but hey, it could lead to a much bigger reward at the end.
So on one side, you've got the standard deduction. This is the no-fuss option. It's a fixed dollar amount that the government just says, here, you can take this. On the other side, that's where itemized deductions live. This is where you get to build your own custom deduction by adding up a whole list of specific eligible expenses.
Let's start by walking down that first path, the standard route. And honestly, it's the road most traveled. We're talking almost 90% of taxpayers go this way, and for good reason. It is dead simple. And thanks to some recent changes in tax law, the amounts are so high now that for a lot of people, it's a total no-brainer.
So, for the 2024 tax year, these are the base numbers you're working with. If you're single, boom, $14,600. Filing as head of household, you get $21,900. And if you're married and filing in joint return, that number jumps to a whopping $29,200. It's just a clean, automatic way to lower your taxable income.
But hold on, the story doesn't end there. The tax code actually throws in a little bonus, an extra boost to that standard deduction for anyone who's age 65 or older or who's legally blind.
So if you're not married, that means you file as single or head of household, you get to add an extra $1,950 to your deduction for each of those conditions. So if you're over 65, you add it. If you're also blind, you add it again. Pretty great, right? Now, for those who are married, the extra amount is $1,550. And here's the key. It applies per person and per condition. So if both you and your spouse are over 65, you get to add this amount twice. If one of you is over 65 and the other is blind, yep, you add it twice then too.
Let's make this real with an example. Meet Jensen. He's 83 and he's not married. He starts with that single base of $14,600. But then he gets an extra $1,950 because he's over 65 and another $1,950 because he's blind. Add it all up, and Jensen's total standard deduction is a powerful $18,500.
Okay, so that was the standard route. Now let's explore that other path, itemizing your deductions. Now this way does require you to keep some records and do a little math, but for many people that extra effort is absolutely worth it.
So, how do you know if it's worth it for you? Well, it all comes down to this one simple golden rule. You add up all your possible itemized deductions. If your total is higher than your standard deduction, you itemize. If it's lower, you stick with the standard. It really is that straightforward.
To figure out your total, I find it helps to think about having 4 main buckets that you need to fill up. Your job is just to see how many eligible expenses you can pour into each of these buckets.
And what are these 4 buckets? Well, you've got medical and dental expenses, state and local taxes, which you'll often hear called SALT, interest you paid on your home mortgage, and gifts you made to charity. Now let's quickly look at the rules for each one.
The first bucket, medical expenses, has a bit of a hurdle. You can't just deduct all of your medical bills. You can only deduct the portion of those expenses that goes above 7.5% of your adjusted gross income, or AGI. For example, let's say Garrison's knee surgery cost him $12,000 out of pocket, and his AGI is $100,000. First, we have to find that hurdle. 7.5% of his income is $7,500. He can only deduct the amount over that threshold. So we take his $12,000 expense, subtract the $7,500 hurdle, and that leaves him with a $4,500 deduction. Next up is the SALT bucket. This is for things like state and local income taxes, or maybe sales tax, plus your property taxes. But here's the catch, and it's a big one. Your total deduction for all these taxes combined is capped at $10,000 per household per year. That's it.
The third bucket is a big one for homeowners, mortgage interest. You could deduct the interest on the loan you used to buy, build, or even improve your main home and a second home. This deduction applies to a total mortgage debt of up to $750,000.
And our final bucket is all about charitable giving. When you donate cash to a qualified charity, you can generally deduct that amount, all the way up to 60% of your AGI. It's a powerful incentive to give back. So now we've explored both paths. You've got the simple standard deduction and the more detailed itemized trail. Now let's move to the final step and see how this decision plays out in the real world.
Okay, just imagine a married couple filing their taxes jointly. We know their automatic standard deduction is $29,200. That's the number they have to beat. So let's say they've kept good records all year and they're ready to start filling up those 4 buckets.
First, they max out that SALT bucket right away at $10,000. Then they add in $15,000 in mortgage interest, their medical expenses that cleared the hurdle came out to $4,000, and they gave $3,000 to charity. When you add it all up, what do you get? Their total itemized deductions are $32,000, and since that's higher than their $29,200 standard deduction, itemizing is the clear winner. That extra work just put hundreds of dollars back in their pocket.
And that's really the whole process. It's a choice between simplicity and customization. Now that you understand the rules for both the standard and the itemized deductions, you're empowered to make the decision that minimizes your tax and maximizes your savings. So the only question left is, which path will you take?